Right. Good evening, everyone. My name is Lisa. I'm a librarian at Saratoga Library. Today's program is on the market and economic outlook for 2024. We're very fortunate to have Larysa Prytula, who is a member of the Financial Planning Association of Silicon Valley, with us today to give her perspective on the market and the economy going forward. Please welcome Larysa.
Thank you so much, Lisa. I appreciate it. Good evening, everybody. I will try to accomplish a big topic today of giving you updates on the market conditions, what we're expecting in the market, what areas of the market will be more profitable than others, and where we are right now generally overall, profit-wise and everything else. So we will try to get a lot of things going here, and after about 40 minutes, I'll be happy to answer any of your questions. If you do have any question, you're welcome to put it in the chat, and Lisa will help me address all of them. And without further ado, let's jump on 2024 outlook. So this year is very interesting. It's not going to be anywhere close to 2023. And the reason for that, because if you remember, in 2023, we had a very serious inflation going, right? If you can look at this chart, you can see that the inflation been going up. We've been struggling with inflation. It's been a big concern for Federal Reserve, and it's been very difficult to control. As a result, Fed has to raise interest rates. Everybody wasn't happy about it. We saw the mortgage rates skyrocketed. The cost of borrowing went up. As a result, economy has been stalling. 2023 was difficult for a lot of organizations, corporations, especially small companies, because cost of borrowing to do the business went up substantially and very, very quick. So, but however, the picture coming in 2024 is quite different. You can see here that average inflation start to cool off, not only in the United States, across the board. And not only that, you can also see that Fed potentially might start lowering interest rates. So let's talk about it. When would Fed lower interest rates? It's a huge question that nobody has exact answer, but usually it happens when Federal Reserve start to noticing that the economy is slowing down more than they want. And as a result, they will start lowering the rates to stimulate the economy, to provide more credit opportunities for companies, for organizations, for individuals, so people can buy houses. It has not happened, and because U.S. economy is still very robust, and we still have a very nice, slow, but growth in the U.S. economy, the Fed is not fast on lowering interest rates. However, stock market has already priced in 4 rate hikes this year. What does it tell us? It means that we really need to lower interest rates, otherwise the stock market starts to be wobbly. Whatever expectations investors have, they haven't materialized yet, right? So we need to be careful. This year is going to be a year of very careful picking of different sectors, also looking at which areas works, which doesn't, which I'll make you familiar with, and we'll talk about what else to expect this year. So here, this slide is showing us what is really normal in interest rates. We've been blessed to have declined interest rates since 1990s. It's a big cycle. The cycle's around 30, 35 years. But my understanding, if you can see average rates in the blue zone, usually between 3 and 6%, and we are right there. So we are going back to norm, and it is very likely that interest rates will not go down below 3% anytime soon because of inflation. And as a result, we should understand that whatever we see the rates in the mortgage and the borrowing cost is probably will stay with us much, much longer. Now, let's talk about recession. We've heard about recession in the last couple of years numerous times. We heard in 2022 there was a recession, and in 23 we expected recession. We didn't confirm recession. And now recession is pushed out to 2024. They say, well, if interest rates continue to stay high, economy will suffer and eventually will roll into recession. But what's interesting that actually, if we look at different areas of the market, they've already been in recession. If you look at travel, that bottomed in recession right after COVID hit, right? People didn't want to travel. If you look at oil, same deal. We saw a huge oil decline around that time, and we already saw a recession on oil. Now, if you see housing had a soft spot somewhere between summer of 22 and summer of 23. Semiconductor industry actually also experienced quite a decline soon after pandemic pushed it up, and then in 2022 we had a huge decline in semiconductor production. There was a lot of expectations that the semiconductor will not do well. Well, guess what? Last year, semiconductor industry in general went up over 45%. Incredible performance. So a lot of industries already have gone through recession, not all of them, but you can see a rolling recession means there have been a recession already in certain areas, and most likely it's not coming. Example, semiconductor. I'm not seeing any recession anytime soon in semiconductor. Now, what happens after the strong year of like 2023? What do we expect? So this is our numbers of 2023 return across equity different benchmarks, right? Emerging markets, Europe, Japan, all non-international markets, and S&P 500. So you can see that that's been a lot of positive momentum happening across all globe. But what's interesting enough, on the very right side, this is the US market, and US market performed the best. Inside of US markets, there were pockets of opportunities. We call them Significant Seven, right? Magnificent Seven. Magnificent Seven is the companies like Google, Amazon, NVIDIA. So there is the companies that pretty much propelled the market higher. A lot of S&P 500 companies, especially those that more on the healthcare side, consumer staples, they haven't done well. They were up maybe, some of them flat, others 5-10% increase, but the companies like large technology, they were up tremendously, and they're basically the one that drove the entire market up. Unfortunately, it was not a very wide participation of the companies increasing their revenues. As a result, very few companies, maybe 25% of the entire S&P 500 made a very big advancement, but the rest of them were lagging. So it's not very healthy environment when only few students out of the few classes holding the entire class grades up. So we want to have much better participation. And as a result, when you start seeing 2024, the participation of the companies increasing in value is actually increasing as well. So that's a great news for us. So I believe that soft patch we were expecting in 23 hasn't happened. Will it happen in 2024? Will we see recession? Most analysts says unlikely. And I was in that camp, but yet to be seen. But even if we do go into recession, it's going to be probably very quick and very mild. Now, here the chart comes from Morningstar. They do a lot of research on projection of GDP growth, the inflation, and you can see in those square boxes projections showing that the GDP is actually positive in the United States. It's not very robust. It's between 2.5, 3%, but it's not negative, which means we might continue grinding higher over time as an economy and as a result as a stock market. Economy and the stock market, they go hand in hand. If we see corporate earnings increase, we will see over time stock market prices go up. Now, inflation has been on everybody's mind and looks like we finally got a hang of it. We consider that inflation, that particular, PCE price index will be between 2 and 3%. That's pretty much close to what Federal Reserve targeted. So as a result, Fed does not need to raise rates anymore. They achieved their target. This is Vanguard 2024 economic forecast. What's interesting about it is also confirms, if you look at GDP growth, that it's positive. Vanguard in general are quite conservative in their expectations. So they believe that the US GDP growth will be a little bit less than 2%, but it's going to be positive. Unemployment rates are pretty tamed. It's really fairly low unemployment considered to historical norms. And core inflation, Vanguard believes it's going to be 2.3% in US. So far, all of this tells us that there is a lot of positiveness going on in the economy, even though it hasn't been outspoken, but a lot of good numbers are coming out from the corporations, from economic data, from unemployment, including inflation. This is the long-term strategic forecast that different companies do. This is one of the analysts that created this, and they're basically saying, if we look at current valuations of all different sectors, and you can see dark, like a teal color, it's going to be US stocks. On the left side, left column would be US large companies. They expect that they will average return about 7.8%, small size companies 9%, and everything else will be below. Emerging markets forecasts have been high, but what's interesting about it, I haven't seen that materialized. And as a result, I'm a little bit skeptical to see that emerging markets will indeed make a lot of money. However, given that said, I would have to admit that we can see Japan starting to make a progress, right? When they're coming out of deflationary trends, we start to see Japanese markets are doing well. I've seen Indian markets are doing well. I saw one of the Indian index is actually outperformed the S&P. And you would say, wow, well, maybe that's a place to be there. Definitely to consider, but you need to be careful. A lot of those indexes encompassing companies that not familiar to us, like a lot of Indian banks. So you need to do a little research, but there are the pockets of opportunities where you can see those economies are expanding. We're mostly focusing on US. This is what we know. So US economy continue to grind higher. As a result, stock market will be positive, most likely this year. Cash. A lot of investors right now in cash because they said, well, hey, if my money market fund at zero risk can pay 5% rate, why would I want to go to stock market, risk a lot of money and get 7 or 8%? True. However, if you look at the trends after Fed stopped hiking rates, where would the cash rates go? Most likely down. If you see CD rates, you would notice that 12-month CD would pay 5%, but 18-month CD would pay 4%. Why? Because expectations that over the longer haul, cash rates will go down. So what does it mean to us? It means to us that we need to find an opportunities at this time. If cash will not be keeping up with inflation on the long run, where do we keep the money that we don't want to put in the stock market? One of the answers potentially could be different type of bonds. What kind of bonds I'm talking about? People who are in a higher tax bracket definitely would be benefiting from municipal bonds. The pays no federal, no state tax on the interest they earn. However, there's all kinds of bonds, and most of them are depressed in price. I will show you some results of last year performance, different sectors, and you will see the bonds just started to come off the lowest numbers we've seen in the last 25 years. So bonds, very interesting opportunity. I spoke about it last year. I believe bonds will give us positive return with much less risk than the stock market. All right. So bonds will be something to watch. You can see that treasuries probably will do well. Municipal bonds, almost 5.9%. So a lot of areas of opportunities in bonds. Now, let's summarize 2023 market. It will be interesting to see what kind of trends has developed, and maybe these trends will continue or not. And for us to decide, do we need to make an adjustment? If 2024 is a completely different year, then we need to make sure that we're adjusting it accordingly in our portfolios. So to summarize, 1 year return in S&P was 25.9%, almost 26%. So excellent return driven by the US large companies, majority of them technology right here in Bay Area. Dow Jones was lagging a lot. It's usually consumer staples companies. They're not big growers. They were not in demand. They made almost 16%, but quite a bit less than S&P. NASDAQ beat all expectations, up 44%. A lot of tech went up. Semiconductor was up 50%. So all of those areas were in huge demand last year. Obviously, year before, they were down 35%, but they made the money back, plus additional 15%. So Russell 2000 is a small size companies, and those usually do well during expansion time. We are not in expansion, we are in a late business cycle. So small size companies usually struggle. However, compared to the large companies, they are extremely inexpensive. This kind of difference between valuations of large companies and the small companies is very significant because we haven't seen this difference in a long time. So I believe small size companies will do well once we start to see rate hikes, once to start to see higher GDP growth, small cap will pick up. Last year it was okay, it made 16% positive return, but not as good as S&P. Foreign stocks, international markets, developed markets, Europe, 18% up, a little bit better than Russell, a little bit better than Dow Jones, but still not as good as US markets. And the last one, emerging markets, not good, 10% return, basically lagged. All the indices haven't done much. Now, areas that struggled in 2023 was energy, utilities struggled big time, and consumer staples. Consumer staples didn't do well. That's related to Dow Jones. Same with healthcare. Of course, not all healthcare is built equally. If you're talking about a few companies like Merck or Lilly, they did great, but others were struggling generally as the sector alone. So you can see a very different results from different sectors. That's why it's so important to know where you want to be, how you're allocating your portfolio. Inside of US, outside of US, you need to know the percentages that will be comfortable for you. All right, so now I want to share with you also the bond performance. Very interesting. So pretty much all of this performance came from Q4 of 2023. The first 3 quarters, bonds did nothing. They were either up or down, no direction. And then suddenly interest rate starts to come down a little bit and you start to see bonds start to make money. So last year, bonds made about roughly between 3 and 6%. Global bonds, more risk, more return. Treasury started to become positive, and general US bond market was up about 5%. So better year than 2022, but not very robust, not at all. Now, 2024, I really wanted to show you year-to-date results. This is as of Monday. Which areas we can look at that we need to be focusing on? Obviously, information technology, right? 9% up compared to S&P, 6.9. So you can see that information technology still leads the market. So this kind of environment we're in, some people call Goldilocks, means inflation is more or less contained and the GDP growth is still there. So economy is still slowly but growing, and we have a good of both worlds. Lower inflation, GDP growth is consistent. That creates an opportunity for a lot of indices to grow. And you can see year to date, S&P has already been up. It's been up and down, but still the general trend is up. Dow Jones lagging again, NASDAQ in line with S&P. Small size companies do not participate. Not the right place for them yet. Foreign stocks lag, emerging markets make no money. But what's interesting is bonds. Bonds this year, surprisingly, haven't done much. So bonds, it almost feels like people are still concerned about inflation. People still concerned that the Fed will not lower interest rates anytime soon. As a result, bond performance year to date is in red. They're minus 0.6 in munis to minus 0.27. So not good year so far for bonds. Where the majority of the money can be made? Technology again. However, we have to be very careful because this could be a trap. If we buy technology stocks that are extremely expensive, we're buying a future promise of company making a lot of money and have a higher earnings. If any of the technology company does not meet expectations of analysts, there'll be a disappointment. As a result, sharp decline in prices. So the higher the price goes, the more difficult it is to make money. So we have to be very careful. Technology is the place to be, but we need to always ask ourselves about the price. Is that the right price for us or not? So I would like to encourage you, if you want to go into technology, do your research, due diligence, and also know what price would be interesting to buy it at. Now, let's talk about what drives the stock market. Actually, simply enough, one of the biggest drivers is corporate earnings. So you can see on the left side in dark blue that your estimated earnings for 2024, it has grown 11.4%. Quite a difference to last year. So finally, we're coming out of corporate earnings recession, which we've seen in 2023. That's why a lot of companies were not doing well, they were not growing, they were not appreciating in price. Only a handful of those that grew in 2023 did well. So now corporate earnings growth in general as the country has a huge impact on the stock market. If we continue growing corporate earnings, you will see a lot of positive momentum coming from the stock market. In comparison and a contrast, you can see that developed international markets earnings are half of US. No surprise, we see a lack of performance from international markets. Unless this number changes, it doesn't seem like international market will be very robust in appreciation, at least for current year. Now, another area where we need to be careful is US dollar strength. If US dollar continue to be strong, we definitely will not see appreciation in international markets because it's a huge headwind for a lot of international companies to sell their goods and services to us. That's very expensive. Emerging markets, different story. Again, on paper looks wonderful. Emerging markets growth is high as long as we can believe in those numbers. But the stock market doesn't like that area yet. So we need to monitor it to see if it goes back to the old times like in 1990s when emerging market outperformed US market for the straight 10 years. We're still not seeing it yet. So positive momentum, you can see unemployment claims are low. You can see S&P indexes growing. We can see new residential building permits. So there is quite a bit of positiveness. Manufacturers' new orders are improving, but there is some negative. You know, there are some other things that leading credit index, people still not borrowing enough, interest rate spreads, all of that is still affecting the economy to some degree. But it's between positive and negative. Right now, there is more positive than negative. Now, what drives a lot of this performance? Of course, the semiconductor industry, no doubt, right? Companies that's listed here, cloud computing, AI software, it's everywhere. Everybody trying to get a piece of AI. And AI investment will be a 2020 and 2030, this decade focus. I do believe that technology will lead the innovations to improve a lot of areas of our life. As a result, there will be a lot of money made, and also we should be focusing on that area in investing. So that's something for us to keep an eye. It's very fascinating area for a lot of people to study and also take advantage of higher earning growth in the companies like these. Okay, so we talked about cash, right? A lot of cash on the sidelines. Is that a good thing? Absolutely. Over time, cash will find its way in the stock market, which means people will continue redeploying their cash into the market. And as a result, market will over time go higher. That's the good news. All right, so let's look at this slide. This is one of my favorite slides. It's showing historical performance of different areas of the market since 1995 after Fed stopped hiking rates. So the dark blue is 1 year performance after final Fed hike, and the light blue is 5 year following after final Fed hike. So you can see cash returns will go down. The bonds will do very well in the first couple of years and still will do fine in the following 5 years. That's historically, again, in the last 30 years. US stocks also will do well and they'll do better than bonds, but they're actually difference between bonds and stock performance is not that big. You can see 16% versus 10, right? But bond carries by far less risk. And then 60-40 portfolio will also bring a very nice return. Why? Because both stocks and bonds most likely will improve in price. So this is what we see historically usually happens after the last rate hike. So in general, it's a positive numbers. All right. So when the pause has happened, you can see different, another way to look at it is you can see 6 months before rate hikes, right? Total return and then rate pause. You can see how stock returns skyrocketed. We just experienced it in the last quarter of 23 and then 6 months after. So definitely positive numbers. If we a lot of analysts expecting that US market will be up between single digit 5% to 10%. It's very difficult to predict, but single digit, high number of single digit return is probably feasible to achieve. Another slide from different sources showing very similar idea. They say what areas of the market usually does well historically after rate hikes. Well, the quality, the kind of very orange color, quality stocks seems to be doing well. And if you look at high quality ETFs, it's ETFs that focusing on specific parameters of the S&P index, not taking the entire 500 companies and invest in them. They filter companies by revenue, by leadership, by profitability, and they only keep those that meet those criteria. And the rest that don't, they take it out of the index. That's called high quality ETFs. Those high quality S&P ETFs in general do well during this kind of environment. And if you compare a couple of those quality ETFs right now compared to S&P, you will see actually they do by 1 to 2% better than S&P year to date. So something to look at. It's a good way to invest because you're literally only with the companies that have a high profitability and they have a good business model. All right, bull market have historically enjoyed solid 2 years return. So we can see that, the years of, different performance, you can see bull market year 1, bull market year 2. So bull market year 1, that was last year, obviously. Bull market year 2, usually lower, right? But average, if you can see it on the right-hand side, average is 12%. If you take all of this white bull market year 2 together and average them up, they kind of come up to about 12%. That's another interesting statistics. Of course, it's very simplified, but something just to give yourself an idea. And if you know that, potentially stock market will be positive between 5 and 12% or whatever, you then can decide for yourself, is that worth, allocating a lot of money in the stock market, or maybe you want to balance the risk out a little bit. Presidential election. A lot of people wondering how the election will be affecting the stock market. In reality, on the long run, since 1936, whether it's a Democrats or Republican, really didn't make any difference. Of course, we know that political environment, legislative changes based on Republican or Democrat election do affect us tremendously. But when you stretch it over the long haul, it's kind of everything is smoothes out. So my understanding that even though we need to be very careful about the political and foreign affairs, looking at new legislation and political environment to be abreast to what's going on and how it might affect investments, on the long run, the political parties both up for making their constituents happy, which means they try to do their best to support the economy and as a result the stock market. So none of the politicians want to, see a bad market because they know it's much more difficult to win the election. So that's why you can see these numbers are very similar. Whether who is going to win, it doesn't really matter in the long run. All right, so we're getting close to our final couple of slides. This is again showing us returns, and again and again we can see what happens. And you can see 6 months after first rate hike, market is still very strong. Market loves rate hikes, and once we start seeing rate decreases, you will see the market will be very, very happy. One thing to consider if we really try to get into the weeds of things and understand what's going on is there is one concern we have is that US stock market valuations are pretty extended. If you see that kind of like a pattern of fair market value range, that's a great area, we are outside of it, right? So stock market is not cheap anymore. We had a great 2023. So corporate earnings need to catch up with the stock prices. So if we're looking at expected returns, the higher the prices, the lower the expected returns. So this chart demonstrates that Vanguard believes that US stock market return should not be higher than 5% this year. Again, very conservative valuation, still a positive number. But they do believe that we're a little bit overextended at the moment. We talked about bonds, and this is basically showing that attractiveness of having both stocks and bonds in the portfolio. Why? Simply because different areas of the market have a different valuations. Stock market valuations, we just discussed, are pretty high, but the bond market valuations are pretty low. So if you remember the old saying, sell high, buy low. So by naturally rebalancing your portfolio between stocks and bonds, and when you sell high, you buy low, you be able to produce a good return on a risk-adjusted basis, meaning you took enough risk to come up with that return. You didn't take extended risk, because risk reward is very important. If you took a ton of risk to make 10%, it might not be as good as if you took a little bit less risk and still got the same return. So risk adjusting return is very, very important. That allocation between stocks and bonds. What is your comfort zone? How far you are from retirement? How much should you have in bonds, if anything? Some people don't have money in bonds because they're young. They're 30, 40, 50 even. They say, I still have 10 years to go. I am okay with volatility. I don't need bonds. Other people say, well, I'm close to retirement. I don't want to see a decline in my portfolio more than 40%. So then bonds will be needed. Municipal bonds fundamentals been very strong lately. We see a lot of good revenue coming out of munis. And this chart showing basically income from municipal that can surpass the taxable bonds. People in general who are in 30% tax bracket plus, they will be benefiting from municipal bonds. Why? Because they don't have to pay any tax. California municipal bond funds excluded from federal and state taxation if you're a resident of California. So it's very attractive to earn yield that you don't have to pay tax on. As a result, your equivalent yield that you would earn otherwise in the taxable bonds would need to be close to 6% in order to beat your 3.6% tax-free bonds. You can see here 3.6% municipal bond would pay. If you're in this 30% tax bracket, it equivalents to a 5.1% taxable. And if you're in the 40% bracket, meaning between federal and state tax rate, let's say it's 30% federal and 10% state, that you need to earn over 6% in order to beat that 3.6 tax-free income. So municipal bonds also are less risky because they usually, many of them are backed up by full face of the state government, versus corporate bonds don't. So we need to look into those to see if maybe potentially it's an opportunity. This is showing municipalities' strengths based on each state. So California has 82 days worth of reserves, which is one of the highest, and means this state can run without any influx of money, just on their reserves for a number of months. It's a good news for us. California is a rich state, and looks like municipalities are doing their due diligence without spending too much money. All right. So expectations again, what I'm seeing, and this is just my writing on this, I do believe that this is going to be a positive year in the market. I do think that it's going to be not without the volatility, especially when we start to see that rate declines are not going down immediately. Market will be disappointed. However, we've been seeing a very nice positive earnings momentum coming from corporations, and they're surprising us on the upside. As a result, stock market celebrates it by moving prices higher. I believe between now and maybe mid-year, we'll see some improvement in S&P performance, but it will be up and down depending on the reporting and also in inflation. But most likely toward the second half of the year, potential for rate hikes might bring a higher performance of the market. I'm not seeing recession at the moment, and I do believe that there will be an opportunity for people to get into the market if they're in cash, either via bonds or via stocks, and to build a portfolio that reflects the risk level, time horizon, and investment objectives. So pretty much that's all I wanted to cover. There is a lot we can talk about it, but I would love to address some questions. I do see we have maybe some that came up via chat, so I'm happy to talk about it.
If any of you have any questions, please enter them in the chat box, or you can unmute yourself and ask Larysa directly. So there's a question, Larysa, about what the source is for your 2023 market results are.
The sources of 2023 market results, is that the question?
Yeah, 2023 market results.
Okay, so let's look at the chart. So overall, market, when we talk about the market, it also depends what we mean by the market, right? So let's look at 2023 chart, and I will answer that question. So if we mean by market S&P 500, then 2023 year brought 25% return in the stock market. If we're referencing S&P, if we're referencing total stock market, which means entire 3,000 securities or 3,500 securities that traded on the stock exchange, then the return was slightly lower. It probably was about 24.5 to 25%. Why? Because a lot of companies that's included in that index are small cap, and small cap companies lagged the overall S&P market. So, but I don't know, I hope I answered the question. So the stock market returned, depends on the index you're looking at, was between 24 and 25% last year.
Okay, this person is especially curious about what constitutes the consumer discretionary and versus the consumer staples.
Great question. I love it. So consumer staples would be the companies that we buy regardless of economic conditions. Toothpaste, medicines, diapers, food items, gas. So something that we have to live on regardless, right? Energy prices, electricity, PG, companies like PG&E or Comcast. This is your consumer staples. A lot of healthcare companies are included in consumer staples. Consumer discretionary is where it would be automakers, totally consumer discretionary, right? It would be jewelry makers, right? We don't need jewelry. So if economy goes down and goes into recession, consumer discretionary got hurt a lot because people stop buying cars, they stop buying expensive items. Good furniture, like very expensive furniture, will be your consumer discretionary. Something we don't have to buy all the time, and something that we can avoid buying if we don't have extra money. So consumer discretionary usually does very well in expansion time, and consumer staples does very well in recession. In 2022, consumer staples went down only 8%, where S&P was down 22%. So that's what consumer staples means we buy them no matter what. So it's very stable during bad times, but it also lags performance. Like if you look at Dow Jones, it lagged S&P. Why? Because it's not fancy when everything is expanding after bad year to be in consumer staples. Make sense?
Okay, thank you, Larysa.
Sure.
Yeah. If anybody has any other questions, please enter them in the chat box. I did have a question for you, Larysa. I was wondering, how do you feel about investing in index mutual funds? Versus ETF index funds? Is there any difference?
Yes, great question also, because there's a lot, we can talk about it probably for another half an hour, but I will bring up examples so it's easy to understand. Because it's very complex, the financial markets become more and more complex because of all of these different new products coming. But let's dissect it very simply. So there's two types of investment. One is index-based, means this index has 500 companies If I buy index fund, it will include all 500 companies, right? So it's index-based. Usually Vanguard has a lot of them, iShares, Spiders ETFs. So a lot of companies have index-based investing. The beauty of it is you know exactly what you're buying. It's usually inexpensive. There is not a lot of trading. So you buy the index, you hold on to it. As long as you like the index, you can hold on to it for a long time. Now, other side of investment called active management. Active management mandate is to outperform those indexes. They believe that with some research, with some technological advancements of AI, some managers has an ability to pick stocks and outperform. What does it mean? It means that you take the same 500 stocks in S&P and now you start filtering them. Either you filter them yourself using different tools and analytics, or you let AI filter it based on certain parameters, right? Based on algorithm. So now it becomes active management. Now, mutual funds is an old school, right? So you can have an index fund, mutual funds, you can have an active funds, mutual funds. Now, with creation of ETF 15 years ago, it's a new vehicle. But ETFs these days used to be only index-based. You cannot buy anything else but ETF, exchange-traded fund. It's a basket of securities that can be traded on the stock market like a single stock, right? So you can see the price every day, you can see it every moment, and you can buy and sell. It's literally like a stock, but it's a basket of securities. Many years ago, ETFs were available only in index form, but now they start to create ETFs that active. For instance, alpha generating ETFs, ETFs that track quality companies. We just talked about it, right? Talk about filtering and quality. ETFs that only focus on companies that has the highest dividend payments, right? So ETF that takes into consideration only certain stocks. ETF in technology, they say we will include only the largest capitalization companies in this technology ETF and we'll exclude everything else. Guess what? It became an active ETF. So ETFs itself does not mean active or passive. You need to look at underlying structure of it. And structure could be completely resembling index or could be very active. It could be a lot of trading going inside of ETF. You just don't see it. Advantages of ETF, it's very tax efficient, means once you buy this ETF, unless you sell it, there is no tax consequences. Or if you buy a mutual fund and there'll be going a lot of buying and selling inside, guess what? You'll receive 1099 end of the year and you say, wait a minute, I haven't sold anything from this fund, but you got a bill saying, well, you just generated 3,000 worth of gains. Please pay taxes on it if that ETF, if that mutual fund is held in a non-retirement account. So the difference is ETFs could be active and passive, and mutual funds can be active and passive. These days, ETF doesn't mean index only. Used to be a long time ago, not anymore.
Okay. Thank you, Larysa.
You're welcome.
One more question. What are some examples of good quality, low beta ETFs?
Good quality, low beta ETFs. So let's talk about these two differences, right? So first of all, good quality. When we talk about good quality, for me, good quality means A, low cost, B, consistency in performance and tracking the index, right? Because if I want to buy a low cost ETF, I'm most likely buying an index ETF. And the three is I see at least 5 to 10 years worth of performance. I'm familiar with the company, I know who they are, what they do. So once all of that is met and I'm happy, I can call it a quality ETF. One example would be a Vanguard ETF, right? VOO, VTI. It could be iShares, ITOT. I thought it could be a few others, from different providers. So index-based ETFs, very easy and very transparent, very easy to find. They're transparent. You can buy them everywhere. So that's my definition of quality. My definition of quality is low cost, good company, good returns, consistent with their mandate. So that's on the quality side. Low beta is also relevant because not like it depends on, you know, what low beta means to each person. Low beta could be beta of the market is 1. So if the beta of this ETF is 0.8, is that a low beta? Or you want to have a beta of 0.5, means the volatility of this ETF is half of the market, right? So low beta, if in our definition, low beta means 1 or less, then you need to look at ETFs that in the areas of consumer staples. Why? Because as we talked previously, consumer staples don't have as much volatility, they don't have as much growth, but they also don't go down as much as the market. So low beta ETF, low beta always means less volatility, but it also can mean less appreciation over time. Beta that's lower than S&P 500 does not come free, meaning if you have a low beta, low risk, low reward, or lower risk, lower reward. So if you want to be in the stock market and you're okay with the stock market risk, you can take a beta of 1 and you'll be just fine. So, I've never seen an ETF says, hey, we have a very low beta, but man, we're making so much money more than the market. It does not exist. It's not possible. So with beta, I like the beta idea, but one of the examples probably of low beta would be stocks that generally don't fluctuate as much. And as a result, they have low beta. Some stocks just don't go up too much, but don't go down too much. There are some stocks that have been having low beta for years, and then suddenly something happened, big bang, and then now they become a higher beta, stocks. So beta is something to watch for, but it's not the only indicator of risk matrix for particular investment.
Okay, thank you.
Thank you.
That's all for the questions.
Okay.
So thank you very much, Larysa.
You're so welcome.